Is the Fed about to move the goalposts and make policy changes to lock in high inflation forever? A few days ago, Mark Zandi, chief economist at Moody's and a reliable vending machine for regime takes, made a push for raising the Fed's inflation target from 2% to 3%. The Fed itself has long argued for this, putting out paper after paper. Paul Krugman, of course, is all for it. Even respected predictors like Michael Hartnett now think they could change to 3% soon. Why would the Fed actually try and raise inflation? Isn't their job to fight it? The key is the Fed pretends to fight inflation that magically spawns in the economy. I profiled a recent paper co-authored by former Chair Bernanke that scoured the headlines, blaming inflation on everything but the Fed. By the way, the Fed did the same thing in the 1970s, pretending they had nothing to do with inflation. Instead, they blamed overpopulation, the world running out of resources, including oil. In fact, the Fed and the Fed alone is the precise source of inflation. They do this partly by printing their own money, literally typing made-up dollars into Excel sheets and using that to buy up assets, mostly government debt. This accounts for about a quarter of inflation. The other 3/4 of inflation, of money printing, the Fed actually licenses to commercial banks by promising them a standing bailout called the, quote, lender of last resort function. This lets banks effectively Xerox deposits and lend them out over and over, called fractional reserve banking, diluting the dollars yet more. This franchised money printer has, over the past 20 years, printed up almost 15 trillion of new dollars, or 750 billion per year. Keep in mind, nobody created anything for those dollars. They may as well be counterfeiters that stole 75% of the buying power of the real dollars that people actually worked for. Instead, that 750 billion in stolen money mostly went to subsidizing borrowers, meaning above all the government, the federal government, and rich people who make up almost all private borrowing. This is incidentally why the Fed is a main driver of income inequality. It ain't free markets making the rich richer, it is the Federal Reserve. So what happens if you go to 3%? Simple. You jump that 750 billion up to roughly $1 trillion every year, siphoned from all of us to government and the rich. It is hard to imagine today, but in the 126 years before the Fed, there was zero aggregate inflation in the US. Things literally cost the same generation after generation. There were fluctuations, yes, from wars or good or bad harvests, or governments licensing wildcat banks as political favors, but inflation did not magically spawn from the economy year after year. Instead, we had real economic growth, with generation after generation knowing their kids would be much better off than they were. Today, instead, we run on a treadmill debating how much to siphon from creators to destroyers, also generation after generation. How to fix it? Historically, there's the easy way and the hard way. The easy way is get rid of the Fed now and let banks stand on their own 2 feet without needing a standing bailout. The hard way is wait until it breaks anyway, so bad that voters get rid of the Fed and put the banks on their own 2 feet, with a lot more pain in between. Twice now, the American people have abolished a central bank. Maybe that should go to 3. Okay, we'll be watching. See you next time.